The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Now, the author of The Path of Least Resistance and the Tech Insider, David White.
And welcome to a beautiful Friday, July 27th. Month's almost over. We've got a huge short squeeze in the action. It's even gone a lot farther than I thought it could. Volume 2.45 billion shares so far with 2 hours to go in the day. Actually, not a bad Friday, but it looks like it's going to be about 3.5, 3.6, maybe 3.7 billion shares by the end of the day. Very interesting looking market out here. We've got probably the big thing is that they'll be growing, that the Dow is above 13,000 again today. Kind of interesting, especially when we see weakness everywhere and a short squeeze of epic proportions out here. Volume's not all that bad because there are a lot of shorts that need to cover. Today is Barbie in a Blender Day, and yes, it's an actual holiday. Apparently, it's a great thing on YouTube to put Barbies in a blender, and there's one company that has a whole YouTube channel. Apparently, they are the samurais of blenders, and they actually can blend just about anything. I saw toy cars, tomato Campbell's soup cans. This thing apparently will take anything and chew it to bits. And Barbie in a Blender Day. But apparently they do it. And yes, itwillblendit.com. But I think you can check it out on YouTube. They've got entire channels of blending all kinds of stuff. Maybe it's a new form of Sledge-O-Matic. But I thought it was grotesquely interesting. Let me put it that way. Let's see what else we have. One of the things we've seen Facebook here today, pretty much, what are we going to say? FB, take a look at it real quick. It sits down almost $3. Had some people email me whether they thought Facebook should be a buy here. I wanted to go through the lockup periods and just how many more shares are going to be coming available. August 16th, okay, what do we got, 18 days or something? 268 million shares are going to be coming available in the next couple weeks. August 15th through the November 13th, 247 million more shares. On October 14th, the day after that, 1.2 billion shares. December 14th, 211 days after the IPO, another 123 million shares come out. On May 18th next year, basically 1 year after the original IPO, another 47.3 million shares. Then all the lockups will be done. But as you can see, an enormous amount of stocks out here that are, stock that still has a huge percentage move here in just the float for Facebook. So probably going to go through more of this, I've got, I don't know what else I can do. Just talking to my engineer here real quick because it is trying to move some things around here on the I don't know, just playing with stuff here. Well, let's see what we got. But I'm trying to see. We've got okay, we got that. We got that. Okay. I'm in the den. I don't know what else I can do here. My engineer says he's not seeing anything in the den, but we can't figure that out. But well, anyway, back. Anyway, hopefully you should see that. Maybe someone in the den will tell me whether they see that. But should be in there. Everything I see here shows that it should be working. Huh? No. There's got to be something wrong then that I can't fix. Of course, it didn't log in correctly, so you might want to get Mike to come in here during the break. Anyway, August 16th, certainly in there. And, of course, the Facebook lockup, what we've got? We've got almost, it's going to be over 2 billion shares coming out over the next year. So it's going to be very tough for Facebook to go anywhere. Charlie Gasparino, if you missed it, it's on YouTube, is basically going after some of the Citibank guys. Wheel was out talking about how banks should be kind of back to Glass-Steagall. And he basically went through the litany of stuff that Whale did and finds it rather disingenuous that he's now saying maybe that wasn't everything correct. But it was kind of interesting. He was supposed to be, under him, Jack Grubman was supposed to be dispensing unbiased advice to investors, would moonlight it as an investment banker, raking in fees from those companies he was touting to unsuspecting investors. Anyway, you might want to check it out, but it seems rather interesting that just a huge amount of, how can you say it, just fraud out there. But Charlie does go through the litany of things that he did. He was in the middle of the muck, according to Charlie. Charlie was the head of CNBC's kind of investigative journalism division for years. Of course, he went over to Fox Business Channel, and just occasionally will come out of his closet when he has people pretty much dead to rights. But there's a lot of dirty stuff that they were involved in, and it still comes kind of interesting. I'm not buying into Draghi's claims. We do have a huge short covering rally out here, but that's what I think it is. It's not a common or accompanied by tremendous volume. The markets become incredibly susceptible to bad news after the shorts have been wrung out of the marketplace and really taking a drubbing as they've taken the last 2 days. Of course, shorts are the natural buyers as the market goes down. If you have none of those and you only have the regular long buyers as it comes back, the volatility can get rather extreme. I'm thinking that either by the end of the day or Monday, I'll probably be buying a lot of puts, and they'll probably be extremely cheap on the opposite side. But we'll have to see how the day closes out here. But getting extremely at the price that they're at now, and the VIX, you've got a pretty good setup like we had in 2010 in April-May timeframe. Just going to be incredibly interesting. Anyway, if you haven't got it, there's a great site for looking at the drought. I found this. It's droughtmonitor.unl.edu, but it is updated, I think, hourly, and shows you the current drought conditions across the country. But a pretty nice site, especially when you're watching these. Of course, it probably wouldn't take one rain to significantly change and pull back the corn market. So everybody's probably watching the weather about as close as possible. On Wednesday's show, I had a guest, and we were talking about, or at least I was talking about, moving averages always being 90 degrees out of phase with the underlying signal. So let's say you had a stock price that was vacillating between, let's say $20 and $10. If you do a moving average, whatever that moving average is, if it's 50 periods, whether it's 50 minutes or 50 days or 200 days, it's always going to be 25% out of phase with the original signal. And no matter what anybody tells you about the way moving averages work, they will tend to always be 25% or basically 90 degrees out of phase with the underlying signal. So anyway, made this little chart here to show everybody But what it really means is that in a 50-day moving average, you know that the first 25% or the first 12 and a half days will be the lag between the actual top of the signal and of the underlying signal and the actual top of the chart below it. So anyway, you can just divide by 25%. You always know that it'll be 25% late. The next 50% will be correct with the movement underlying the signal. And the last 25%, well, of course, will be late again. This is why most professionals don't spend a lot of time looking at 50-day and 200-day moving averages. By definition, if the signal was perfect, it's only going to be right 50% of the time. It's going to be wrong 50% of the time. There are, and I've done the studies, will show you that there is a bump at 50 and 200 days. It's probably the self-fulfilling prophecy. If enough people use it, then it becomes real. One of the things I like is Basil actually talks about using his 9-day moving average, and actually you can get about 3% better than the flip of a coin at 10 days, actually 6 to 10 days. At 50 days, you're about 50%, a point and a half, or 51%, 51.5% actually better than a flip of a coin. And thanks for the den saying that I don't have a chart, but nothing I can do about it. I've turned on the chart mechanism and actually had somebody come in here and work on the den right before the show. They're going to come in here during the break and hopefully fix it so you guys can see it. I'll probably show it after the break. Actually, I'll show it again. We got about a minute here, so I'm going to talk about our special guest on August 3rd. Of course, next week I'm going to 5 days a week. So every day at 2 o'clock Eastern Time, you'll catch me. Next Friday, we'll have Dr. Sam Savage is the author of The Flaw of Averages. So I'm kind of showing you these averages here today, why we can, why we underestimate risk in the face of uncertainty. But he has a lot of neat ways of looking at averages and understanding it, and we're in the probability business. I think a pretty interesting book. We'll be discussing how averages work and what you need to know as a trader to use them. His favorite analogy is that there was a bunch of statisticians and statisticians went across the river with an average depth of 1 foot, but they all drowned. Of course, right in the center, it was 12 feet. So, kind of interesting. But read his book, pretty good. Not a lot of heavy lifting in the math department, but a lot of good ways to think about how averages work. We'll try to show the charts when we get back.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her small cap roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, David White, Larry Pesavento, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows. Plus, see all the charts as they happen live during those shows and have access to archives of those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
This segment is brought to you by Goldfields. For more information, just click the Goldfields banner on the front page of TFNN.com.
As we come back, if people are in the den, they should be able to be seeing my charts now. We got our little technical difficulty taken over. There's the moving average proof, and I guess the thing is, if you really want to get into how well a lot of indicators actually work, there's a great book called Evidence-Based Technical Analysis, and it shows you actually how to go and test indicators to see whether they truly work or not. As a engineer working in video and audio, both in software and hardware, this is one of the easiest things to understand is you don't want to have the lag so big. And the bigger your window is, the larger the lag is in being able to actually process it. Probably everybody's seen this phenomenon. It almost looks like bad movies, Japanese kung fu movies where the words never match the mouth. But you'll see it a lot, especially in smaller cable stations where the delay is upwards of a half a second or 1 second behind the actual video. It's a little disconcerting. Not half as disconcerting when the video is actually behind the audio. It drives people absolutely batty. But I've got a couple stations down here in Tampa that actually you can see that some processing equipment at the cable station is delaying the audio by a good half a second behind the video. Always obnoxious. But that's called lag, and you just continue to see how we got going on here. If I can close a few windows down now that we got our everything started. Anyway, what I've also on the second chart have is basically if you look at it as a degree issue, the 15-day moving average is always going to be 90 degrees out of phase, or a 10-day moving average is going to be out of 90 degrees out of phase. But just know that you're going to be at least 25% of the samples before you actually get into the sweet spot of those indicators. I've shown here both the 50-day, which is going to be 90 degrees out of phase, 180 degrees and 270 degrees out of phase. A lot of times we'll use, or we talk on this show about displaced moving averages. And by using displaced moving average, you kind of like shift the average back into position. And that's why the 3x3 displaced moving average works pretty good. Always liked that Basil, although I don't know if he ever tested it, found out that 9-day moving average is probably the best estimate of using it. And I don't think it's so much the average, but it's kind of a ballistic path. If a stock's moving up ballistically, it's going to have some level of trajectory, but still probably the best moving average. Anywhere from 6 to 10 days is going to be in the high 2% better than a flip of a coin. Doesn't sound huge, but basically all of the casinos work at about a 57% average, and not a bad edge if you can play it all the time correctly. But I think I like kind of price and volume in some of those others, but all the indicators are fairly good. The reason I brought this up is we will be doing a trade like a computer webinar, and that'll be on, I think, the 26th or 24th of August. We've got that coming up, and this is some of the work I'm starting to do for it, so make sure you hang on to that. Continue to see S&P up nicely. Let's see if I can bring up my charts, finance, because I had to close them to get the Tiger's Den working again. So what do we have here? We're in there. Oh, there I am. Start seeing how a lot of mine are doing. Not doing too bad. I'm still in a few of my trades here. But what I wanted to look at, it was volume. 2.6 billion shares, so we'll watch how this tracks. Anything less than 4 billion shares would be a huge warning signal in the marketplaces. I'm going to predict that we come in at somewhere between 3.6, 3.7 billion shares for the day, especially 2 light volume moving days up. A lot of times there's one more, and I suspect they may actually be able to push this up one more day. I'm going to stay short on the occasion that they can't, just because you can walk in, and this is a market where we've seen a lot of stocks, in fact 80% of them having a huge move down. There's a few that actually beat the marketplace, but the path of least resistance is probably down when we don't have a lot of people monkeying with the market. Of course, the old saying is don't fight the Fed, but as soon as the Fed's shot his bullets, I suspect I'm going to be really, really short. I'm looking at options one of the few times, I think since February, that they are starting to look actually fairly sweet out here.
Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades have have been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to TFNN.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and the Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
And as we come back, wanted to make sure that if anybody wants to give me a call about their particular stock, you can give me a ring at 877-927-6648. And, right now, if you do call 877-927-6648, I've got our guest book from Wednesday, 9 Algorithms That Changed the Future, The Ingenious Ideas That Drive Today's Computers, from John McCormick. And the first caller at 877-927-6648 gets the book. And hopefully my engineer in there will give me at least your first name and where you're from so I can announce where we're sending the book. And he needs to, of course, get your name and address. But we're looking at a few stocks out here and a few ETFs. One of the ones that seems to be of most interest to me today is IYF, and that is the Real Estate Index Fund. Kind of interesting. We've had kind of a at least an attempt to break out a lighter volume, but it has pulled back and closed below it. It is now trying to close back over the previous high. The one I'm looking at here, what I think is a good indication, is the May 1st high at 7.7 million shares, $64.87, the high of May 1st. It kind of skimmed along that high, had at least a few attempts to get in there. Had 11 million shares on the 12th, but it didn't break that high. Volume was light through those highs. Probably the biggest thing is just the volume today in the IYR, which is very, very light, showing about 2.5 million shares as it tries to go above them. I'm just wondering if it isn't time for the real estate sector at least to pull back into this gap, which I suspect needs to get filled around 63 before you go back a little bit higher. But that's one of the ones that has got me going on first out here. Another one are Ford and GM. Looked like maybe they had been bottoming, and I was looking at the lows in General Motors as being very interesting. In fact, I was talking to Steve Rhodes on Wednesday, or maybe it was yesterday. Maybe I was IMing. We were talking about some various trades, and kind of interesting to see kind of the way both General Motors and Ford were trading. Looked like that they had a good chance that they had been making at least a small, how can I say this, a small bottom out here. And we're going to get back to it in a minute. And in the meantime, we've got Paul from New York calling, and he wants to talk about the S&P. How are you doing today, Paul?
Yes, hi, good afternoon. Could you please go over how perhaps the European crisis may have to be resolved? Perhaps maybe the Fed gave them an ultimatum for this year's elections. I think because we're bankrolling their problems that they were told, okay, it's got to be resolved before, October, so it doesn't negatively affect our elections.
I suspect, and I put this in my newsletter, that in a year from now, I hallucinate that Groggy's going to be doing a perp walk, and that all his little buddies got together and decided to run the biggest short squeeze of all time. When we had Merkel leaving on her first day of vacation, so she couldn't say no, and let this thing drive. And I think it's gotten kind of a life of itself. If there's no specificity, if there's nothing to sign, there's absolutely nothing going on here. And I think they just took an opportunity to jawbone the market. Greenspan did it a number of times. I haven't really seen it as strongly with Bernanke, but it's not uncommon for these Fed or Fed-like positions to just jawbone the market. They've done absolutely nothing. They've made this grand plan. It's still like herding cats. You're expecting for Germany to pay for the whole thing, and the Germans, after 10 years of paying huge, and having a huge, just a hangover from reunification with their Eastern partners, I just can't see it ever being politically expedient for Germany to pay for it all. And that's basically every plan that they've come up with is, if Germany will just pay for it all, it'll be okay. And go ahead.
The last time this happened, Germany didn't put a dime in it. It was essentially the World Bank that sold it.
Yeah, but some of the money was coming back from Germany. Germany, I guess the biggest thing is you got to know that even when I was over there early in the 90s, I was shocked to find out that Germany pretty much owned all of Europe already. And I mean, this was just when the wall was coming down. And I had all kinds of people, Russians, trying to trade me tanks and AK-47s for any kind of video equipment at all for the business I was in. I mean, anything that would get a television station up and running, they were willing to, trade me a MiG fighter or a T-72 tank or bazookas or anything that wasn't nailed down over in that country. But at that point, basically, Germany pretty much owned everything already.
But David, if you were the Fed or if you were high up in politicians here and you have a lot of people that you had to be responsible to get reelected and you have a fiat currency, wouldn't you at least put up a facade where it's smoothed over or everything's covered over until after the election? I mean, if you have
they will try, but there's an unwritten rule that the Fed will not get in front of this, and.
But they already have. I mean, if they haven't already yet.
Yeah, they haven't really done anything. I suspect that we're in for a massive disappointment when the Fed doesn't come out and really do anything next Tuesday. I think the GDP numbers don't give them any kind of political cover to go and do that. You're going to have to see something like 8.5% unemployment. I just don't buy it right now. The reason that I don't buy it is there's just that unwritten rule. The Fed does not get involved 6 months in or previously into an election, and I look at Bernanke hiding everywhere he can, especially if you looked at the polls over the last few days. He can read the polls too. They're in the paper every day. There's one thing that and that's politicians will throw each under the bus as fast as possible to remain in power, and Bernanke's no different.
Well, two questions. What exactly are the polls saying, and what are the bonds saying? And the bonds seem to, with the great move today, seem to indicate some type of. They're not stupid people. They print up a lot of money. They seem to be indicating there's some type of solution there.
The polls right now show that Obama is in the exact same place as the Republican candidate was on the same day, and we saw what happened there. So basically, right now.
But that's not. I mean,
I'm saying that I don't think Bernanke's going to do a darn thing, especially with the way the polls look right now. Because if we went to the polls today on likely voters, we see that he loses by 5 points. Or Obama loses by 5 points. So I suspect that we're going to see what we have right now is just huge amounts of jawboning. There's absolutely nothing going on. There's nobody writing any checks. There's absolutely nothing that happened any differently other than a grand plan announced yesterday morning, and nothing has moved. Now, what
about the bonds? I mean, a heck of a lot of money came out of the bonds.
Right. Yeah, I mean, basically they caught everybody on the wrong side of the market. I mean, it's no different than gold or silver or anything else. Everybody was so heavily short that all you had to do, it was like going into a powder keg with a sparkler. All it takes is one spark and everything's going to blow up. Everybody was.
They were long the bonds, but I mean, if they thought that there was never going to be a solution in Europe, why would they sell the bonds? I mean, some people
because they had to. Everybody gets. These markets are this way as long as I've been around, which is full-time trading, and trading since 95, full-time since 98, is the market always goes to extremes on one way or the other. It was like crude market. There was no way that it was going to support $155 a barrel. But it got there, and it couldn't support, $78 for very long either. So, you get these markets that get way out of whack, and they always overshoot the ways they should go, and basically, way too many people in a marketplace. You always have these huge reactions to a crowded side of the market, one way or the other. If you go back and look at the aftermath of the 1929 crash, there were huge up moves all the way to the bottom.
Right. But we had short-covering spikes prior to this, and the bonds really weren't changed, or they were just, maybe a point or a point and a quarter change. But today, it appears there was a huge move in the bonds, even with, a relatively modest spike in the S&P.
Yeah, I don't think it's anything other than hugely, there were a lot of stocks where people were hugely short, and they moved. There were ones where a lot of people were hugely long. And, we're seeing these huge moves in companies like coffee companies. But, Starbucks to have a move like it had today you make it sound like it's in a vacuum, and we're not seeing companies actually getting pummeled, or even stocks popping, 20%, 30% overnight. But there are, just a huge amount of stocks and other things moving also. when markets get like this, one side of a trade gets hugely overbought or oversold, and it always snaps back hugely. And it doesn't mean that that moves over. It just meant that that side was way too crowded for that trade. It'll all come back into reality sooner. But all markets overshoot themselves.
Is there any additional factors like what are your feelings about the full moon series that some of your counterparts discuss? And into the quarter or into the month market pattern?
There's a natural rhythm to the marketplaces. Some people say it's the moon. I say it's options expiration. If you really look at a lot of that stuff, but I mean, the moon's pretty much pretty close to the same expiration cycle that you see in the marketplace. Does it correlate fairly well? Yeah, but I don't think it's, the moon or astrological issues. Let me put it this way. I would rather believe that there is some kind of organic reason for it. Like, is there a lot of business on the 15th and 16th of the month at Walmart? Well, yeah, everybody gets paid on the 15th and 16th. Doesn't mean just because the moon came out there that it did something. It may correlate. Let's say that, for several years, the moon's always coming out on the 15th. It works, I think, only because, you get this natural cycle in markets and organic reasons. And I think the biggest organic reason in the stock market is mostly options expiration and futures expiration. You don't see this as much in that matching in the European markets where they actually expire their options on the first of the month instead of the third Friday.
Okay, so if you're going to go long puts, what is the duration? Do you hold those before you think the market starts to go in our favor?
I think you've got probably Monday, maybe Tuesday, and you're probably going to see this market is set up exactly like the last couple of days of April in 2010, or the first couple of days in May, which is the 5th, I think, through the 5th. I'll see if I can actually pull that up here in this. Let me go back just a little longer, and I'll zoom into that time frame. Let me see if I can find it. Was it April, May, right there? Are you watching on Tiger TV or in the Den?
Yes.
Okay. And I think this was it. You saw a whole bunch of stocks rolling over like we see right now. Stocks just getting absolutely beat to death. Back into that 1219 level. You had kind of the high I kind of look at this as almost like the high of April 26th. You had a couple of days where it kind of continued. You had a huge deep move down to 1065.79 on May 6th. And of course you had a huge pop back up on May up to May 13th. And then the thing just continued to roll over until it found a low. And I suspect, let's see if I can clear my throat here. I suspect that we've got something like that period going on right now. That's kind of what I'm thinking we're going to have. We're going to have probably some kind of huge disappointment on Tuesday when the FOMC comes out, does nothing. We'll probably hit some kind of low. Everybody will buy it because buying these markets has worked on every dip. And then you're going to see this thing slowly roll over. Everything I see shows the trajectory for the 1st of November to have an 8.5% unemployment rate. So, I'm thinking that we kind of have probably a tough 60 days in front of us out here, at least in the markets.
About the GDP numbers, they seem to be pointing in a positive direction. Is it usually of a market bottom?
I'll come back. I didn't see anything positive in 1.5% GDP numbers. But if you want to hang on through the break, we'll continue this discussion.
Okay.
Are you looking for a precision edge in the market, something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Time is the great equalizer of all mankind. Time doesn't care about winners or losers, who succeeds or fails. Time only cares that you played the game. Question: are you playing the money game? Is your money working as hard for you as you are for it? I'm Steve Rhodes, author of Mastering Probability, a daily trading and investment newsletter service, and we're celebrating our 1-year anniversary. In year 1, we generated a 30% profit. Plus, I provided 26 hours of live coaching to my clients. My daily newsletter service is available by 8 a.m. each day and covers the stock, futures, currency, and commodity markets, along with all the current patterns that you can trade. Each newsletter is packed with education, and it's yours for as little as $3 per day. And for the next 30 days, you can try it risk-free. Click on my name, Steve Rhodes, on the homepage of TFNN.com and begin your journey to great wealth today. If you're waiting for a better tomorrow, remember this: today's tomorrow will soon be yesterday, and your clock is ticking. Mastering Probability. Now is your time.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
And we're back. I don't know if Paul's still on the line.
Yes, it's still here.
Okay.
Bloomberg was spinning these numbers that came out today in a positive light, and obviously you're more appropriate on your view. But in terms of the markets that you would short, what is the most vulnerable? Which ones would you short first?
Right now, as far as I'm looking at it, it's more of a stock picker's market. The stocks that are most vulnerable to weakness in China and Europe are the ones you want to be shorting. Right now, technology's really taking it in the chin. We've seen a lot of stocks like Apple kind of miss earnings out here, and I don't suspect that is going to is going to change a lot. I think we've got about 60 days to get through this, and we're probably going to find some kind of bottom. But until I see some kind of washout where everybody believes that it's a bottom, it's hard for me to believe that this is going to last, and we aren't just going to wake up with a down market of 50 or 80 points one day on the S&P.
Well, isn't Apple sitting on support, and didn't the Russell spike up the most? It didn't have the longest extension of its rally today. I mean, Apple, it seems to be stuck on support around the 572 number. It seems to hit a brick wall every time it gets there.
Yeah, it's. I suspect that it's in a trading range down to about 533. So, probably the last time it got down around 533, I think it went down to like 520 or so, 522. And that's where it really found buyers. But you could see for days that they were in there. Every time it got around the 530 level, they were buying it back. I suspect...
Didn't Apple play this game last year? I mean, they kind of withheld some of their sales to the next quarter.
I don't know if they're really withholding their sales. There's two things that are really troublesome about Apple. One is that their iPhones make twice the margin that their tablets make. So when they lose iPhone sales, it hurts twice as much as a tablet sale. And right now, everybody is pretty much gotten over the 4S, and they're waiting for the 5 to ship, which is, I guess they're saying, somewhere in about 120 days. So right before the end of the year, maybe October. It's kind of hard. They really wouldn't say, so you really don't know. But I'm suspecting that it's October, 1st of November, for them to ship the iPhone 5. But some of the numbers...
Comment on their additional revenue. I mean, they have the iTunes and all these apps that they generate, the dollar revenues or additional.
Yeah, but I mean, if you look at a chart of it, I don't have time here to find it, but I was looking at a chart of the revenues. I mean, 3/4 of it's iPhones. It's just it's overwhelming when you look at the margins that drags in and the rebates that are popped back from the carriers. It's just massive, and to try to replace that is problematic. I was going to get into it with Tom tonight on the Tech Insider Hour, but basically the new sales for Android smartphones are 3-to-1 to iPhones. If you're buying a new phone for the first time, you're also 3 times more likely to buy an Android than you are a iPhone. Only if you had phones for over 2 years, which means you probably had an iPhone already, are you more likely to buy an iPhone. So I'm not predicting the end of the world. I'm predicting kind of more of a market like Google saw after their run from $100 to $700. I think you've got maybe a year or 2 years of this thing fighting through these $500 to $600 levels until their next products.
Yeah, I'd love to see a breakdown of the revenues, because I thought they had a license to steal because they collect revenues where the other competitors don't.
Google's still making is starting to make nice money. We'll be back in a minute.
Okay.